Chapter 6, Merchandising Transactions. Okay, what we'll do in this presentation is just focus on the journal entries. And the idea is that you understand that if you've got a merchandising business as opposed to a service business, okay, you've got somebody that sells goods, then they're going to have, other business transactions and other accounts that they use, okay? And just to get an idea of one way that it's handled, the book records everything net and assumes that all discounts are taken by everybody. I've never seen it that way in practice, but that's okay. We're to just do exactly what the book says, and we're going to keep it simple. So here are some examples. Here, the first we've got a purchase with cash, and we've got a purchase of merchandise inventory. So inventory increases, cash decreases. Okay, here's a purchase on credit. Again, inventory increases, but we increase accounts payable. Okay, accounts payable. And then we've got a purchase that has a discount. And the discount is 2% in 10 days, net 30, okay, 210 net 30. So what we're going to do is record the merchandise net of the discount. This assumes that the discount will be taken, and it doesn't record the discounts separately, so we don't keep track of those. A lot of companies do keep track of them, but we're not going to. So we're going to debit merchandise inventory 980 and credit accounts payable 980, because that's the net amount that we would pay if we paid it within the discount period, okay? If the discount period is missed, then we've got to put the money back in inventory. We've got to increase inventory by $20. We would still decrease the payable by $980 because that's all that's in there is $980. And then we would record a credit to cash for $1,000 because that's how much we had to pay. Okay, all right, so just think that for purchases and sales, we're recording them net of any discounts that are offered. Now here's some sale and credit card transactions. So here's a cash sale that we've got a debit to cash and credit to sales. Credit sale would have a debit to accounts receivable and a credit to sales. But what's different about these is that we also have to record the cost of goods sold, because what we're doing here is we're using I'm going to say a perpetual inventory system. Okay, which means that we keep track transaction by transaction, and computers really do this. Okay, we don't do it so much, but that's a big assumption here in what we're looking at. So the cost of goods sold is $1,400. So we'll remove debit cost of goods sold on the income statement, or cost of merchandise sold, and credit merchandise inventory. So what is left on the income statement then is we've got sales for $2,000, less cost of goods sold for $1,400, gross profit of $600. Okay, on a credit sale, same thing. We've got sales of $2,000, cost of merchandise sold is $1,400, so gross profit would be $600. And remember that the sale is recorded not when cash is paid, but when the sale is earned. When we've completed doing what's required to earn the revenue. Okay, that's when we record the sale. Okay. Now another issue in this chapter is freight, and we've got a couple different ways to think about this, because you've got buyers and sellers. Okay, so we can sell goods with freight terms and we can buy goods with different freight terms. And the two things that we're interested in is FOB shipping point, that's free on board shipping point, and free on board it's called point of destination, okay, back in the day. So shipping point means it becomes the buyer's property as soon as it leaves the seller. Okay, title passes, so the goods would have to be insured in here, and typically the buyer would pay for the freight at that point. Okay, for free on board point of destination, the title doesn't shift to the buyer until it arrives at the buyer's door. That's when title passes. So in this case, the seller would pay the freight. Okay, it doesn't become the buyer's property until it gets all the way here with the to the buyer. So let's see what that means. Here's an example. This is right out of your textbook, and we've got on June 10th, Net Solutions purchased this merchandise. They purchased merchandise for $900 with terms of FOB shipping point. Okay, so that means it's a purchase. Okay, so we are the purchaser. We're buying goods, And that would mean that since it was FOB shipping point, we would pay the freight of $500. So personally, I think the hardest thing to remember when you're doing these problems is you've got to slow down and think to yourself, am I the buyer or I'm the seller? Okay, which am I in here? That's like an important thing to understand. So we have two transactions here to record. We don't have any discount here, so we've just got a purchase of merchandise inventory for $900, debit inventory, credit the payable. And remember, the reason, I don't know if you know this, but the reason why the company's name is here is because there's a subledger with just their name on it and how much we owe them, okay? The account payable is what we call the control account, and there's a lot of detail underneath it that's listed there by customer. So that's why that's there. Then we pay the freight of $50 on the June 10th purchase. Now this is what's important here. Freight in is an inventoriable cost. Okay, so freight in goes in the inventory. Freight out is a selling expense. So when we ship something to a customer and we might pay the shipping on it, that is delivery expense. It is not like an inventory transaction. But assets are recorded at everything that it costs to get the asset in service and ready for use. Okay, so I would debit merchandise inventory and credit cash. Alrighty. Now here's FOB. Now we've got a sale, and the shipping is FOB, point of destination. So we are selling it, and it doesn't become the buyer's property until it arrives at the buyer's business, okay, on their dock. So we would be responsible for the sale. And we sold merchandise to this Krantz company on account, $700, terms FOB destination. The cost of the merchandise sold was $80, and Net Solutions pays the freight of $40 on the sale from June 15th. So in this case, we've got accounts receivable is increasing by $700, okay, from the sale, and credit the sale for $700. And then we've got to record the cost of merchandise sold, and that's $480. Debit cost of merchandise sold, credit merchandise inventory for $480. And finally, we pay the freight of $40. This is on a sale, so this is freight out. And freight out is a delivery expense. Okay. Now you want to do the class problems on this too. I've got a couple here that I thought we'd just go over. Just to see what the entries would be like with discount terms. And in this, first, these are sales transactions. We sold merchandise on account. This is, I think, the first problem in the Pro Copy book. Sold merchandise on account to Equinox for $18,900 with 1% in 10 days, net amount in 30. And the cost of merchandise sold was $13,300. So first record the sale. And the sale would be recorded net of the discount, okay? So debit accounts receivable and credit sales, and then we've got to record cost of goods sold. Cost of goods sold would be $13,300, okay? And credit merchandise inventory, because it's a perpetual inventory system and we're recording everything net of the discount. So the income statement at this point would have sales of $18,711 less cost of merchandise sold of $13,300. Okay, now in the next one, we sell merchandise for $11,350 plus sales tax. Cost of goods sold was $7,000. Well, sales tax is collected by a seller, but it's remitted to the state. Okay, don't keep this money, that's for sure. That goes to the state really fast. And if you ever want to end up with chains around your business, what you want to do is not pay your state sales tax. And you'll be out of business so fast it'll make your head spin. I mean, they literally chain the doors. So we've got a sale. This was to retail cash customers. Okay, did you see that? Retail cash customers. I'm going to make that a different color. Maybe red. Okay, so that means it's a cash sale. So we've got sales of $12,031. So that would be $11,350 plus 6%. for the sales tax. The sales recorded 11,350, but the sales tax goes into a payable account where it's got to be, remitted to the state. 681. Okay, cost of goods sold was $7,000. Debit cost of goods sold, credit merchandise inventory. Okay. And then this one is real straightforward. Sold merchandise on account for 55.4. Terms FOB shipping point, which means we don't have to pay any freight on it. And the cost of merchandise sold was 33.2. So in this case, here's my debit to accounts receivable, credit sales, debit cost of merchandise sold, credit merchandise inventory. Okay. I'm just going to show you this next one. I've got one more page in here with a lot of entries on it. And these are different transactions. This is also in the Pro Copy book. But here we purchase merchandise from UK Imports, 14,448, and the terms are net 30. Okay, so there's no discount here. So we increase merchandise inventory, increase accounts payable. Okay, and the next transaction, now let's look at this one. We purchased merchandise from Hoagie, $99.50, terms FOB shipping point, which means we would have to pay the freight on this, and the discount of $210 net end of month, and prepaid freight of $220 was added to the invoice, and I don't like the way they said this. I think it's hard to interpret what really happened. So let's look at what happened here. This is on the 4th. So our merchandise inventory is 13. This is to who? This is to Hoagie. Oh, it's here. $99.50 was the invoice, less 2% for the discount, plus $220 for the freight. Okay, so they added the freight right to the invoice. Maybe this Hoagie shipped it for us. Okay, so we would have a debit to merchandise inventory and a credit to accounts payable. Okay, for the $99.71, that's the result of this. Okay, so this is probably long enough. Make sure that you do these transactions, and if you've got any questions, let me know.